All right. Thank y'all, by the way, for entertaining me today. Hopefully it won't be too boring for you. Most of it is elementary, but I've got some stuff that we may have a chance to get to by the end of the afternoon. Let's see. Who uses financial statements in here on a daily basis? Anybody use them every day? Well, if you don't, you should be, because everybody in here probably has a 401k plan, right, or some type of deferred comp plan. So you want to look at that, and you want to look at the underlying financial statements of those 401k plans. All of the proxies and things that they send to you, you probably want to look at those. And that way you can tell what they're doing with the money you've invested. And if you have to, rebalance your portfolio. So management uses financial statements pretty much on a daily basis to look at how they're doing, where they're going, where they've been, and where they're going to go. Competitors. Your competitors probably, if you're public especially, look at your financial statements. Customers a lot of times want to see the financial statements. Employees probably, especially if it's a public company, employees are constantly looking at your public filings. Governments look at some type of financial statement, usually tax returns of some type. Investment analysts look at these so that way they can, the investment analysts sometimes make or break public companies. They basically take the financial statements and analyze them and give buy or sells information based on the analysts. Lenders, obviously, banks, other financial institutions want to see your financial statements because they're lending you money and they have a lot of money at stake at times. Rating agencies also want to look at the financial statements. Investors, obviously, we're all investors in some form or fashion. If you have a deferred comp plan, you're an investor. So it's really important to be able to look at these financial statements and understand what these companies are doing, because generally speaking, management of these large corporations, their compensation is directly tied to the stock price. They receive stock compensation. And a lot of times, the management will do just about anything to raise that stock price. We see it every day. We see the SEC putting people in prison for artificially inflating their stock price to gain compensation and competitive advantages. So who are the users of financial statements? Pretty much everybody. Why are they important? One reason they're important is financial statements are the backbone of our economy, pretty much. Like I say, everybody owns securities. You can look at any of the indexes, and they have skyrocketed since they fell in 07, 08, I think, if I remember correctly. And as you know, the audited financial statements are extremely important, because if we didn't have audited financial statements, it wouldn't put everybody on a level playing field, wouldn't put public companies on a level playing field. They could pretty much do whatever they wanted to do. A lot of times what you'll see is the auditors basically have to force, a lot of times, their will on the publicly traded companies, and sometimes it's even Congress that has to do it, and basically tell them how to report things, so that way everybody reports everything the same. So it makes the analyst jobs easier. There are 4 basic financial statements. We probably won't look at all of those, because the last one is just just for public companies. And the example I've got today is extremely elementary. So there's a balance sheet. There's an income statement. Cash flow statement that's extremely important. It tells you where the cash came from and where it went. A lot of times I've got clients and they say, I made X number of dollars. What happened to the cash? Where'd the cash go? Did it disappear? Well, no, it didn't disappear. You spent it somehow. Let's see, statement of stockholders' equity or shareholders' equity. that's pretty much for just very large SEC reporting. That way you can tell where who's diluting your shares and why. Balance sheet is as of a certain period in time. It's just a cutoff. Like, generally speaking, we have year ends December 31st or June 30. So it's just a snapshot at a point in time that gives you your assets. Assets are generally, and I like to talk in terms of, us as, individuals, what we have. So let's say you have a personal balance sheet. Just like a company. You've got a personal balance sheet. You've got assets. You've got a home. You've got cars. You have portfolios. You have 401k plans. All those are assets. Then you have the liabilities, which none of us like to pay. You got the mortgage, the car payment, and, student loans or whatever else that you have. Those are the liabilities. Those are, something that you owe somebody else. And those aren't good a lot of times, especially if you can't make payments on them. Then you have your equity, and the equity is nothing more than just the assets less the liabilities. So, more assets over liabilities means your equity is larger. That's all that means. And a lot of times equity is extremely important because that's the cash that you have at the end of the day. And if you have a negative equity, that ain't good. Let's see, the income statement. The income statement basically shows us over a period of time how much money we made or lost. You never want to lose money, but it happens more than you would like to think. So, and obviously you can't lose money very long, because if you're losing money, you're doing one or two things. You're dipping into the equity that you've already built, or you're borrowing money. And a lot of times you can live off of credit for an awfully long time, especially if your vendors allow you to do that. And they're the ones that generally get stiffed at the end of the day when you file bankruptcy. You do it in the middle of the night. And that way the creditors never see it coming. And then they get absolutely nothing. And it puts them under a lot of times. The income statement starts at the top with the gross receipts, sales. And net sales a lot of times because we have to allow for returns and things of that nature. Cost of goods sold, extremely important. You want to monitor the cost of goods sold or cost of sales, whichever the case may be. And I guess a lot of you in here are in the service industry, so you're concerned with the cost of sales as opposed to cost of goods sold. I did an example before I knew it was mostly service people that were going to be in here based on a wholesale company. But it's still going to apply. We're just going to have to take out the inventory and cost of goods sold and think of it in terms of cost of sales. For most of us, cost of sales is employees, time that the employees spend. And you take the sales less the gross profit, you come up with the gross profit. Then you got your what we call SG&A, sales, general, and administrative costs. And then there's income tax, if applicable. Sometimes it's not applicable, sometimes it is, it depends. Nonprofits obviously don't pay tax unless they have other income that's not associated with their nonprofit. Then you get to your operating profit or loss, and next we have other income or losses, which other income gains, losses from sales of property, or or maybe you've got transactions, gains or losses on foreign currency. Cash flow. This tells us where our cash, what happened to our cash, our cash that came in, our cash that went out, and what the cash balance is at the end of the day. We start at the top with the cash, and then you have the operating activities, which is generally from operations. And then the receivables and payables, the increases and decreases in inventory, receivables, and payables. The next thing that we have is the investing activities, and that is the cash from plant, property, and equipment, generally speaking. In other words, you purchase assets, it takes your cash down. Depreciation is non-cash, so you add it back. Financing activities, that's where we're borrowing money or issuing securities of some form or fashion. Let's see, statement of shareholders' equity. This is just, you know, the only reason you'd want to look at one of these, excuse me, is if you are looking to try to figure out what happened to the equity section. Some of the equity sections in the large companies are complex, but that's, a lot of times that's the way management gets paid. They get paid in stock comp, whether it be options or any other type plan that they might have. We start with the net profit or loss for the accounting period, and then the increases or decreases for shares, issuing shares or redeeming shares. Then you've got the dividends that you have to pay to the shareholders. Some companies don't issue dividends, but a lot of them do. That's why they keep their shareholders happy. They'll borrow money to pay you a dividend if they have to. As long as you're not looking at their financial statements, they can care less. Stock grants to employees and directors. That makes up a good bit of it. The employees and directors, they get paid, a lot of them get paid with stock comp. Gains and losses directly associated with equity, those are few and far between, but there are, in some instances, GAAP makes us push things through the equity section as opposed to the P&L, so it doesn't make you look better than what you are. Effects of changes in accounting policies. A lot of times we will have changes in generally accepted accounting principles, and we'll have to force the changes back through the equity section. Effects of a correction. This is correction of errors, really. If you made a mistake, then you have to run it through equity for a prior period adjustment. That's all it is, prior period adjustments. Notes to the financial statements. This is where the story is really told. Instead of just looking at the, you know, the balance sheet, the four financial statements, the notes to the financial statements. You can't really read the financial statements without looking at the notes, because the notes explain exactly what they did. It tells the whole story, you know, the ugly truth. That's the reason at the bottom of the financial statements you'll see, if you read the financial statements, you'll look, and at the bottom there's a note that always says read the notes. It says the notes are an integral part of the financial statements. These are the disclosures that are required, and you really can't tell what they're doing unless you look at the disclosures. MD&A, Management Discussion and Analysis, that's limited pretty much to the publicly traded companies. You know, I think they've pushed it down now, but for private companies you don't have to do the MD&A. The MD&A gives management a chance to put a positive spin on something, or tell you, you know, where they're going, what the trends are, and what they plan to do. You know, and that's the reason they qualify these things by saying, you know, these are forward-looking statements and you can't rely on them. The financial statement analysis and ratios. We'll look at these, and a lot of times the companies, especially the public companies, they'll disclose these. You know, and they'll say, okay, this is how we did, and this is the benchmark. They'll do some things against the benchmark, unless they're, you know, not. If they're not exceeding the benchmark, maybe they won't do the benchmark. All right. Let's see. Hopefully, I'm not going too fast. It'll be easier to see. This is just slide presentation. It'll be easier to see when we look at the. This is a typical balance sheet that I would pretty much see on a daily basis. And it's a wholesale company. And we always look at financial statements year over year. That's the way they're always presented. If you'll look at publicly traded companies, the way they present financial statements, they're always year over year. They may not show you the change or the percent change, but they're always comparative financial statements, what we would refer to as comparative financial statements, year over year financial statements. And The analysts generally add the two columns because we'll add two columns, $1 change and 1% change. And that way you can kind of look and tell how well you did. Of course, the balance sheet really doesn't tell the whole story. You have to look at it integrally with the income statement and the cash flow statement. So I've got those three for us to look at. This is just a typical wholesale company. You see their cash increased dramatically. So they've got a few assets. They've got some receipt. They've got some cash, a good bit of cash. They've got some AR, accounts receivable. They have some inventory that they sell, that they turn over. They've got some fixed assets and accumulated depreciation with those fixed assets. And again, this is just a snapshot of a given point in time. This one probably is December 31st. Yes, it is. So this takes the picture and tells us exactly what our position is as of a point in time. We've got some liabilities, AP, accounts payable. We've got some notes. We borrowed some money. We've got tax liabilities. This happens to be payroll tax liabilities. This is a sub-S corporation which does not pay income tax. The shareholders pay income taxes on their personal income tax returns. It's a flow-through type entity. But it works the same as a very large publicly traded company, except for the fact that they don't have a flow-through net income. You get taxed twice. Publicly traded companies get taxed twice. They're taxed on the income, and then again, when they issue a dividend, the shareholders are taxed on the dividends. And these should balance, right? I mean, we look at it, and we come down to our total assets have to equal the total liabilities and equity every single time. That's the beauty of double entry bookkeeping. It agrees every single time. It's a simple formula. Of course, we all know the formula. The most important thing is looking at trends and things of that nature. I guess y'all are going to go through your budgets, right? So you want to look at trends, and 2 years really doesn't give you much to go on. You have to go, and you're trying to do it forward. But trends a lot of times will tell you where you've been, and sometimes where you don't want to be again. If you had a bad year before, you're going to have to do one of a couple things, right? Or one of several things. And some of them aren't so pretty sometimes. But you have to do that to survive. So it's very important that you know where you've been. This is historical accounting. It tells you where you've been, not necessarily where you're going. But it can give you some trends, right? And we'll look at some of the more important trends with the financial ratios. So the first thing you would want to look at, you would say, okay, why did my cash increase? Why have I got this much cash? You can look at the balance sheet, or we look at the cash flow statement and be able to tell what happened, how that cash increased. So the cash increased from $26,000 to $43,000. So if we go back here, that's our net income, so that's going to generate a lot of cash, $51,000. Generated a good bit of cash. And the changes in the accounts receivable and accounts payable, negligible. So still we're looking at the net income that generated most of the cash, $52,000. Get a pickup for the depreciation because it's non-cash. You add it back. We bought some computers, so we have to deduct that from cash. And then looks like we paid down our note, paid down our loan, which uses cash. This is the principal, by the way. The interest is buried in net income. This is principal payments only. And then we were able to take out $50,000 and put it in our pocket as a dividend. We don't put all that in our pocket because we've got to pay tax on some of it. So the cash increase, we can look, and it's primarily driven by that one number, net income. So we made $50,000 and we took out $50,000. then the other changes are what increased the cash. Let's see.
Talk about the depreciation.
The depreciation? Depreciation is nothing more than you take a long-lived asset, and let's say you assign, when you read the financial statements, basically companies have to pick accounting methods, and they can't change the accounting methods. They have to stick with the same accounting methods. So once you pick an accounting method, let's say you buy a computer. You want to determine what the life of that computer is. The way technology changes these days, the book life's probably 3 years for a computer, because you're going to have to buy a new computer in 3 years to keep up with the technology, because the one that'll be driving you crazy in 3 years is the slow. You know, when you first get the computer, it's great. You know, it's so fast. It makes our lives a lot easier, you know, and then 3 years after you buy the thing, it's a piece of junk. You got to throw it out and buy a new one, right? Because you're sitting here waiting on doing this, waiting on it to calculate. I remember when I first started practicing years and years ago, we got a computer. I was like, oh, this is great, you know. Some of the tax returns that take 8 hours for them to calculate, you know. So we've come a long way, technology, and it's continually advancing. But the way you do that is you would say, okay, generally speaking, for book purposes, it's a straight line method. The method is straight line. So you'll depreciate, let's say we paid $3,000 for that computer. You know, let's say it has a 3-year life, so you're going to depreciate $1,000 a year. And so this number right here is nothing more than the book depreciation on the fixed assets. That's all it is. And the reason we do that in accounting is because you expense it over time, because you're going to have to buy it again. We know that. If you go out and purchase, let's say, you know, I like to use the textile mill example because they used to be heavily into plant property and equipment. Let's say you go out and spend $10 million on equipment. That equipment at some point is going to be obsolete. No matter what, you know, how well you maintain it, at some point it's going to be obsolete. You're going to have to replace it. And depending on how fast the technology changes, you may have to replace it a lot quicker. So we match the life up to the asset. So that way, at the end of the day, you've ran the expense through the profit and loss statement. And hopefully, you've put aside enough cash as a sinking fund to go out and purchase new equipment, or you have the means to borrow money to purchase equipment, because they're not going to give it to you for free. So you've got to have a means to actually purchase it again, and that's the reason we run the depreciation expense through the income statement, through the profit and loss. If y'all have any questions as we go along, please stop me. Yeah, that's fine. I'm fine with that. The income statement. The income statement tells us, you know, what we did for, typically speaking, for a year. We can, a lot of times, public companies report quarterly, because you know, investors are clamoring for information. You know, if there were any way possible for them to do it monthly, they'd be doing it monthly. You know, because everybody wants to know how well the companies are doing, so they know what to invest in. Typically speaking, for non-SEC companies, non-public companies, non-public entities, typically speaking, we will produce financial statements annually, unless a lender or somebody else needs the financial statements. So, and we generally report on an annual basis, unless you're public and you have to file a 10-Q, so you report quarterly. This is on an annual basis, and again, it's comparative year over year. And this is going to help you with your budgets, because your budgets are probably annual, correct? You do an annual budget. So your budgets are annual, and they are, I would say, a profit and loss type budget. I've never done a budget otherwise, unless we had to have balance sheets. And sometimes we just plug the balance sheet numbers to match whatever we think we're going to do in the, on the income statement. So your budgets are probably on an income statement format. In other words, you you don't necessarily have sales, but you have customer receipts. You've got receipts from customers, gross receipts. So your customers are going to, or let's say, and depending on where you're at, I guess maybe a lot of that might be Medicare, and some of that is maybe fixed income. So that should be relatively easy to budget because you know what the federal government's going to pay you per procedure. The only way to increase that is do more procedures. So that means you've got physicians and nurses that have to work a little harder, work a little more efficiently to increase the gross receipts. There's no other way to increase those gross receipts when it comes to Medicare. And I suspect a lot of the receipts are fixed even by the insurance carriers. I would suspect that they only pay a certain amount of money, and that's all they're going to pay. If you're going to do the same, gross receipts as you did the prior year to make an additional profit to cover expenses that are going to increase, let's say 3%, then you have to gain 3% efficiency in your cost of sales. How are you going to do that? I don't know. It's, a lot of times you squeeze people and processes so thin, they break. You can only squeeze things so much. And I know since 2008, everybody's squeezed everything. I mean, you can't make a penny squeal any louder. You just can't. But that's where processes come into play a lot of times. So engineers, a lot of times these people that are IT savvy, people that are IT savvy are worth their weight in gold. They make processes, they automate processes for us. A lot of times the engineers used to automate processes for us, industrial engineers. They automate processes for us so we could, they would change the assembly line or something to make it more efficient. And they might gain efficiencies of 3 or 4%, and that might make us look really good for a year or two. And then the efficiencies fall off and you have to change things again. And if there's one thing I've learned, nothing stays the same. It's continual change all the time. And to gain a competitive advantage, you've got to change faster than the competitor. If the competitor changes faster than you, he'll put you out of business. That's his goal. Your competitors want to put you out of business, and you're trying to put them out of business. You want their market share. That's just the way it works. We don't want to deceive ourselves and sit back and say, oh, it'll be okay, because it won't. I can tell you, whole industries, you look at the steel industry, used to be one of the, cores of the, what we would refer to as the Rust Belt these days. There's a reason why they refer to it as the Rust Belt. Because, they're all out of business. All the steel companies, except for very small steel companies that have found a niche to survive, they're out of business. So whole industries, well, we know that with the textile industry. Textile industry overnight, well, not overnight, but in the South, I would say it took them about, let's say, 15 years to move everything overseas. And the Chinese are seeing it now because they're not the low-cost producers anymore. Those textiles are going to other countries. Vietnam, Cambodia, wherever the labor is cheapest because it's labor intensive. So multinational companies do it all the time. They find ways to make themselves more efficient because they've got shareholders they got to pay. And everybody else, we have to do the same thing. We have to be more efficient at what we do, gain efficiency somehow. Instead of doing the same thing, try to figure a way out to do something better. You just, and you have to think of it before the competitor does. That's the reason I like the IT people. I don't know anything about IT. All I know, if the box don't work, I don't work. But the IT people will if a lot of times you want them on your team because they can tell you a better way to do it and a faster way to do it. And you might have to invest some money up front to gain those efficiencies, but over time it pays you back. So here we've got the typical profit and loss statement, and we've got cost of goods sold. For y'all, that would be just cost of sales. Your primary your primary cost of sales is probably going to be medical supplies and staff. You know, you have to pay the physicians and the nurses and the techs, I guess. You know, advertising, bad debts. Bad debt's very important. And this is relatively small compared to his sales. And this particular vendor takes, this particular company takes credit cards. So, you know, they make people pay up front as opposed to financing receivables, which is a good thing to do. Everybody has a credit card these days, so if you can get a credit card payment, get the credit card payment, pay the 3% and keep moving, because you don't want the bad debt. Rather pay the 3% now than take the hit for the bad debt, which is 100%. It's better to get 97 cents than 0 cents. Bank charges, everybody's got those. I always say everything's negotiable. Everything in life is negotiable. You know, if the bank charges me $10, I go say, you know, I go ask them, I say, well, how can I get rid of that bank fee? What can I do? You know, do I need a compensating balance somewhere? You know, I mean, tell me what I need to do. We negotiated. I mean, you know, you could easily, I'm telling you, easily cut out 5% out of the SG&A. You go back to your vendors, and we've done it before on several occasions. We'll go back to them every year. If they give us a price increase, you know, and the thing, don't let them lock you in on a contract. Make them annual contracts. When that contract lapses at the end of the year, if they try to go up on a price, I say, mm-mm. So I'm gonna go out and get competitive bids. Go out and get, don't get 3, get 10. You know, and I'm not necessarily saying pick the lowest cost, because we all know the lowest cost isn't the best. You know, I mean, if they give you poor service, if they're not there, then they're worthless. You know, so the last thing you want to do is change, because all change ain't good. You know, if you change and then you got to go back to the previous provider, you know, they'll get their price increase somehow. You know, so you want to know what you're getting into before you change vendors. You know, check the references or whatever you need to do before you change vendors. We always, if we were happy with the vendor, we would try to negotiate a better price and not change vendors. Sometimes it's a lot better to do that than it is to change vendors, because if you change vendors, they give you a 100-page contract. You got to read all the fine print, and it takes staff to do that. So we would always try to stay with the vendors that we were happy with and just try to get them to help us some, so we don't go out of business. You know, and they understand, because they're in business too, and they can take haircuts. So, you know, the insurance, that, you know, not necessarily, you know, general liability. That's all this is, probably plant, property, equipment, general liability. For y'all, it might be malpractice insurance, probably increases dramatically. But you're probably self-insured, so you control it that way. You probably have a reinsurer, I suspect, and you control the cost that way. You know, and if you're large enough to do that, that's great. If you're fully insured, you're going to take a beating. You have absolutely no control at all. We've seen that. We've seen it not particularly in the general liability and property insurance, but we saw it in the medical insurance. If you would let the insurer have their way, they're going to increase premiums 25% every single year. And I know they would always come back to us and give us a 25% increase and tell us what a deal it was. Well, try going to your employees and passing that cost along. Because the employer can't afford to pay any more money. They're paying the shareholders out of dividend. So, you know, what are you going to do? You got to fight for your employees, right? So you go back and you tell them, I can't. I'll tell you what, you come tell the employees they got a 25% increase. If you'll do that, we'll give them a 25% increase. You know, they'll all be armed, I promise you. I'll arm them before they come in the door. So they will work with you. You know, it's just a matter of asking, just saying, listen, let's meet somewhere. You know, I can't do this. There's no way. And you know, if they won't meet you, then you have to go out to other vendors. You just have to. It's, you know, but you always threaten them, and you always do it annually. So you're continually doing this with vendors all the time, trying to get the best price. Not necessarily the best price, let's say the best value. The best value. Let's use that terminology instead of best price. Best price isn't always the best value. And a lot of times I look at, year over year, and a lot of times we see trends, and we would want to do, let's say instead of 2 years, looking at trends, you might want to do 4 or 5 years. Because then you can use regression analysis or something of that nature to figure out what it might look like in the future given a certain gross receipts. But we just have a year over year here, so we'll go with what we got. We'll start at the top. Sales increase 11%. Not bad for this size company. It's actually really good. And if you can keep that number less than what the gross receipts increased, which is your cost of sales, then you've done something because your gross profit increases exponentially. We see just a increase in the gross sales of 10.88, or is that 8.9? I can't read it from here. Sorry, 8.9. But the gross profit increase 11.52. Right, strong. That's everybody wants to see a gross profit increase of excess of 10%, I can tell you. Last thing you want to see is that number be a negative number. That ain't good. That means that you've lost ground. You got to make it up somehow and make it up fast because you're not going to cover your SG&A. And what I refer to this analysts and these analytical procedures is what we're doing now is just a top down, and then we'll go bottom up also. I don't know how much time I've got. I should have set a timer. Y'all tell me when.
About 5 more minutes.
5 more minutes. Oh, good grief. Okay. We might go over some. All right. So, let's see. Bank service charges. He probably just negotiated better fees. But what you want to do is you want to look at the big movers. Not necessarily what I refer to as the chump change. This contract labor, dramatic decrease, 44%. So, he must have negotiated a better rate or went to another supplier. That's all I can figure. Let's see, internet expense increased dramatically. Maybe he went to a faster service for one reason or another. The biggest movement looks like this number right here, which is the payroll and payroll taxes. And doesn't, and what we would do, a lot of times we would throw them all in together. We'd call it payroll, taxes, and benefits. That's the employee costs. He was able to decrease his payroll $37,000, 15%. Most of us can't do that. And there's a trick to how he did it most likely. Most likely he just cut his own salary and paid himself out the $50,000 without paying the payroll taxes on it. We see this all the time. But a company other than a sub-S company you can't cut salaries like this. It's impossible. Not unless you have to. If the gross is down and you have to make, this a zero instead of being negative, you do cut costs. Employee benefits are they were increasingly, they just increased at exorbitant rate. So we would have to try to cut those benefits somehow. And we would start with the things that not too many employees were using. Let's say we had 500 employees and only 50 of them used a certain service, then we would cut that out first, or have the employees, if they really wanted it, then let them pay for it themselves. I can tell you one typical thing that just about every company in the country cut during the financial crisis of 07, 08, 9. You saw the match go away for deferred comp plans. It was an easy cut, right? I mean, it's just too easy to do. So we always try to get the low-hanging stuff that, the employees really doesn't notice so much. Your typical employee will never look at their 401k plan statement. So it was easy to cut the match. Nobody ever knew it. I probably had 500 people, I might have 5 calls. So real easy to cut. Let's see, the rent expense, I think he signed a new lease. So you want to look at the numbers that move big, the big moving numbers when you're looking at year over year. Trade shows, obviously he's trying to get his gross up, so he did way more trade shows than what he did in the prior year. That's probably the biggest, it is the biggest percentage increase. But he was able to increase his net income by, let's see, 279. Most of us will never see that. But there's a way he did that. The only way he did that was pretty much he cut his payroll, or the officers cut their payroll and took distributions as opposed to taking a salary and paying the payroll taxes on it. So these 3 financial statements kind of work in tandem. The balance sheet tells you, what your net worth is. The more income you make, the more it's going to go in your net worth. For a publicly traded company, they don't keep net worth. They distribute it to the shareholders, but it keeps shareholders happy. They give it to the shareholders in dividends. You can look at your 401k statement and you'll be able to see those the dividend payouts for the very large companies, for multinational companies. It's the way they keep shareholders happy. They pay a dividend. Let's see, and these are just some ratios that you might want to look at, especially if you have benchmarks, competitors. If your competitors publish their benchmarks, what you want to do is calculate their ratios and calculate your ratios. And you don't necessarily need to use the ones that I have here. Use the ones that's the financial ratios that will be pertinent to you, to whatever business you're in. So if you are ABC Plumbing Company, then what you would want to do is you would want to look at somebody in your local area that's also a plumbing company to figure out what the benchmarks are. And a lot of times you can get trade publications. Trade publications are extremely valuable, and they'll give you a lot of information to benchmark yourself against. What you want to do is you want to be better than the competitor, because if you're not better than the competitor, like I say, the competitor's going to put you out of business because he wants your market share. It's all about survival. And to survive, you've got to do what it takes. I mean, it's I refer to it as a dog-eat-dog world. And we see these financial transactions going on all the time. And the reason you see them going on is because a lot of companies, they can't survive on their own. You saw the bank mergers, all the banks failing. Well, the banks were failing for a reason. They made very poor financial decisions. The federal government steps in and says, okay, we're going to loan money to the larger banks so they can sop up all the bad ones that failed. If you don't have that competitive advantage and you're not strong enough, you will at some point have to get swallowed up by somebody bigger. That's just the way it works. So I guess, do we have more time? If we have more time, I will.
5 or 10 minutes for some questions and answers if anybody.
Okay, all right, I'll take questions if anybody has any. And I know I went fast, and it's very simple. This model is extremely simple, but hopefully you got something from it. Maybe we'll do one a little more advanced or something and look at some financial statements from publicly traded companies and compare them to see what they've done and see how well they're doing or see how poor they're doing, or we can bring in our our portfolios or our 401k plans or the financial statements that we get and throw in the trash that they send you, along with the proxy, the annual reports that they send you. Maybe we don't throw them in the trash, maybe we bring them one day and look at those, and that way we know what to invest in, and we're not at the mercy of the broker, if anybody uses broker anymore. Most people, they've got away from the broker and opened an E-Trade account. Bad decision, bad for me anyway. Any questions? Mhm.
It's very indicative, and I like the way you, in your presentation, you showed the different types, the liquidity and the leverage, the activities, the profitability, because it's very important to, when you're doing your financial statement analysis, not to just look at one ratio. It's, don't base everything on just one, look at a combination of them, and use them as a benchmark, but also, like you pointed out, the inventory turnover, you think, well, inventory turnover is gonna be different for, depending on your industry.
Right.
If you're a grocery, if you're like a manufacturer, maybe you want a, 30, 60-day turnover, but if you're a grocery store, then you want on your bread, then you want a 30 or 60-day turnover on your bread. So, every industry is different, and that's why it's good to look at the industry averages and everything. But like I said, and then just how, your activity, your inventory turnover, your accounts receivable turnover. Maybe if you're not, getting your customers aren't paying, maybe you need to change your terms with your customers. So these are really good, not just for benchmarking, but, looking at your own business and maybe some changes you need to make in your company. And, I don't know, I'm sorry, I don't know all you guys, but, a lot of times if you, maybe you see something, you can use this type of thing to go to your manager or your boss or whoever and say, I've noticed this, and maybe, we should sit down and, talk about, some changes that we.
Yeah, if it smells bad, it is bad.
Yeah, ratio analysis is really, really a good way to analyze your financial statements.
Yeah, and don't just, there's probably 100, but you want to use the ratios that are specific to your industry, and you want to benchmark yourself against your competitors. Like I say, trade publications might be a good place to get those. But a lot of the hospitals do publish their financial data, I suspect. I don't read it, but I suspect they do. They're nonprofits, or some are for-profit. I guess I could look at some for-profits, but I guess Greenville's a not-for-profit. Greenville Hospital System, not-for-profit. But there are some that are for-profit, and they'll generally make a good bit of money from what I recall. Their prices have been pretty high.
So one of the natural extensions of whatever financial statement you use is translating that information to the frontline staff. So any suggestions on how best to translate? Because if you take this and put this to the frontline staff, it just overwhelms them. Not that they can't handle it, it's just out of their territory. So what are some of the best takeaways from some of this financial statements?
Yeah, I never have inundated people with financial things. Most people, they don't like it. It's dry as dirt, right? It's not any fun, right? It's just a tool. What I've always done with staff is I always say, look at your job. Give me your job description, and you look at your job description, and tell me what you need to make you more productive. What do you need? I've always asked them, what do you need to be more productive? We need you productive. We need you efficient. What do you need?
But you mentioned before, our biggest costs are labor costs. So productivity really is the best use of labor. So as we're trying to translate productivity to the frontline staff, it's inextricably linked to this financial statement, fortunate or unfortunate.
It is, and to get them to pay attention to maybe certain key things that they can control, right? I like to use this example. UPS. UPS knows exactly how many right turns it takes. They're just that efficient. And a lot of times to get those efficiency expertise, you have to go outside, and they're going to charge you money. But in the long run, you're better off if you have somebody that's all they do is they specialize in the field that you're in, and they can help you gain the efficiencies you need. Just like UPS, they know exactly how many right turns it takes on their routes. Those guys, they have efficiency down to a science. And it's important just to relay that, I guess, these concepts over to the employees. to say this is how everybody makes money, and it is. If the company's not profitable, you're not going to get a raise. You're just not. Matter of fact, the friend next to you, if the company's not profitable, they won't be here next week. So I mean, you have to make sure the employees know that everybody benefits from gaining efficiencies. I always like to incentivize people too. Okay, you give me a good idea, right? Give me a good idea. I'm not putting a suggestion box out there because they fill it full of junk. But, come to me, the door's open. Come to me and tell me a better way to do this. If you can think of a better way to do this, then you're going to get paid. Everybody gets a bonus, right? I mean, if the company's profitable. If the company's not profitable, don't expect a bonus. We've always put everybody in the boat together. Get in the boat and row. Don't want to row, then everybody else toss you over. It's very important for the companies to make money, and we just have to make sure the employees know. And a lot of small companies, they don't want their employees to see how much money the company's made or lost. The more profitable companies, especially the larger ones, they get the employees on board. That's difficult to do sometimes. Some employees just aren't going to get on board. They're just not. But if you incentivize people enough, they'll make it happen. You just have to show them what's pertinent to them and say, how can we do this differently to change this ratio?
Let me ask a completely different question. With the FASB changes and leases, particularly.
The FASB, yeah, leases, yeah, that's a mess.
Because there's going to be some changes.
We're going to book them all.
Yeah, so how does that affect us? What will we see differently because of that?
I don't know if, let's see, you're nonprofit, right? I'm not sure, well, yeah, you will file FASB. So, okay, yes, what you're going to do is you're going to book all the leases. You're going to book all the assets, and you're going to book the corresponding liabilities, and it'll be fair value.
The problem is we've got to maintain certain debt-to-equity ratios for our bond covenants. So is that not going to screw us on that?
Well, what you've got to do is be proactive. You've got to be proactive and get the information out there. The bondholders obviously are going to know that is going to affect the ratios, and it very well could blow the covenant. Of course, you can get covenants waived every single day. Blow the covenant, they waive it. Blow a covenant, they waive it. Blow another one, they waive it. They understand. Personally, I don't like the idea, but it is what it is. They come up with these things and they force it down to everybody else. So we will be reporting. I'm hoping they're going to kill it before we have to do it, but it doesn't seem likely. We're going to a fair value accounting, like it or not. They're still pushing for international financial standards. I don't like that either, but there's lots of things in life I don't control. And so whatever they give me, yeah, I just do it. I don't fight the system so much, right? I just say, well, this is ludicrous, but okay, I'll do it. Anything else? Oh, thank you very much, by the way. Thank you very much for coming. I appreciate it.